Okay, Jahangir Aziz, head of emerging markets, economics research and commodities at JP Morgan, is now joining us. Jahangir, great to have you with us here. You know, markets latch on to reasons, or at least we force reasons onto price action. Wednesday you had the consumer confidence numbers, which were strong. Markets were strong. Yesterday we had jobless claims out of the US, GDP numbers, which were strong. Markets sold off. I mean, just confusing kind of price action overall on the equity side. But what are you making of all of the data that we're getting out of the US?
Look, I mean, we have to acknowledge that we are in a very bizarre world where good is bad and bad is good. So I think, if you look at the, what drove the market down today, it was the revision in the third quarter GDP in the US and the fact that the first-time claims were not as high as people had thought. And I think that goes to show you that, the market had probably brought into the idea that the Fed was probably, close to being done. But clearly, this is more moves towards what the Fed has been telling us in FOMC meeting after FOMC, that they are not close to done, even though they have downshifted. And I think that's basically what is driving the market at this point in time. And I would say that, along with what the uncertainty around Fed, even though the Fed has been very clear about where they want to take the terminal rate to, in addition to that, the uncertainty around the reopening of China, and I would say that the coming disinflation that people are preparing for in the next 2-3 months. I think those are the three things that are driving markets, and it's very hard to sort of figure out what is going to dominate one over the other.
Jahangir, good morning and greetings of the season to you. It's not a very chirpy mood here on Dalal Street, but nevertheless, people are, I guess, in festive mood as we head into the end of the year. But in the new year, from an Indian market standpoint or from an economy standpoint, what are the top 2 or 3 things that you would watch? The standard question, of course, is how many more rate hikes. But what do you think the larger, overarching theme will be?
So I think what has been confusing me, and is the fact that let's say the government's 2022 to 23 growth forecast is 7%. If we just take that, then the government itself is saying that in the next 6 months, the economy is going to slow to about 4.5% to 5%. That's just pure arithmetic. You had a 13.5% first quarter of the fiscal year. You're at 6.3% in the second quarter. So if you're going to have a 7% average, you have to slow down to 4.5%, 5% for the next 6 months. And then both the consensus and parts of the government are talking about 6-7% growth rate in 2023-24, which means that they are expecting, a 4.5%, 5% economy over the last 6 months of the fiscal year to jump by another 200 basis points in a world where all of us agree, depending upon what the numbers are, but let's set that aside. All of us agree that the global economy is going to slow down. And I think that sort of is the one that's confusing me in terms of where the market in India is looking at these numbers and where they're looking for and where they're heading. And I think this idea that India can add about 200 basis points in growth rate when the global economy is going to slow down from, let's say, 3 to 1.6, 1.7, I think that's going to be very, very challenging.
Okay, that point is well taken. Jahangir, investors in India are also latching on to the belief that there is commodity disinflation and that's going to help earnings growth in 2023. Do you think there is a risk to that commodity disinflation may not play out to the extent that the markets and investors are anticipating?
So again, in the commodities space, I think much of it depends upon what is going to be the pace and the manner in which China reopens. So we have a view that, in the first half of next year, China is probably going to struggle to generate any positive growth. And in the second half of the year, once they're able to acquire some form of natural immunity of about 35-40% of the population, and that's a very tall task. Once that happens, you are going to see China reopen and China growth actually pick up very strongly. And I think that's the time when you are going to see materials prices, industrial metals prices actually move up. my guess is that the market is trying to bring that forward. On the oil side, on the energy side, I think much of it depends upon supply. And on the supply side, I think there are two really drivers of what is going to drive oil prices in the next 6 to 7 months is to what extent the U.S. continues to replenish its reserve stocks. That's one thing. And the other is, how does OPEC react to the decline in prices? I mean, if OPEC goes and cuts another 500 million barrels a day or something like that, I think they're going to boost up prices. So I think much of it depends upon these supply responses, or rather responses from OPEC plus, as well as, what exactly is the US going to do with this SPR?
Right. Jahangir, here in India, do you, again, I mean, the belief is that we are closer to a peak in terms of rates, interest rates, maybe another 25 basis points. What's your opinion?
We have that same view, that another 25 basis points and probably is done. But I would say that the monetary policy minutes, I think, would probably lead to people starting believing that the rate hikes are not done. I think the fact that both the governor and parts of the monetary policy committee actually said and were concerned about premature pausing basically says that they are not really seeing it the way in which the market is seeing it or we are seeing it. My sense is that that is actually a good thing. The premature pausing actually could lead to serious financial instability, opening up sometime in next year. So on one hand, I'm actually pleased that the governor and parts of the FOMC did talk about, the dangers of premature pausing, but that obviously pushes our own call into this thing, because we actually did expect another 25 basis points and then pause.
Okay, but do you think that the RBI policymakers would want to see a decisive inflation decline before making any change in their policy stance? Because the narrative is that inflation is expected to be quite sticky, around 5% through the course of FY24.
I would say that much more than the pace of disinflation, more or less we all know that core inflation is going to get very sticky, right? I think much more than what happens to Indian inflation, I think what happens to global financial conditions is what is going to drive RBI policy. That's my sense. That, look, you are going to see the Fed continuing to raise rates, and let's say by the end of first quarter of next year, they're probably going to pause somewhere slightly above 5% or 5.25%. By that time, most likely you're going to see the end of dollar strength. At the same time, in the next 3 months, you're going to see some very spectacular disinflation taking place in emerging markets. India is not going to be one of those countries, or Asia is not going to be one of those countries, because inflation wasn't very high. And markets are going to start pricing in most of emerging markets, significant rate cuts. I think that is where I think the concern is, and if the RBI follows that and pauses prematurely, I think there is a serious concern that they could open up, a point where financial instability, particularly pressures on the rupee, can reemerge much more strongly.
Sorry.
Jahangir, thank you very much for joining us today, and season's greetings to you. A very Merry Christmas from everyone at CNBC TV 18. Get into a quick break. Our list of top 10 stocks is lined up next.